What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode, we're doing another stock market technical analysis update. The stock market's practically in free fall right now, and there's a lot to go over tonight. But before we get into it, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along with all of my updates. Now, first up, we have the ticker symbol SPY, which is our SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. All right, so we see today was not the best day in the stock market, and we saw the S&P 500 SPY ETF going down negative 2.73% today. So this is how the stock market works, where it takes the stairs up and the elevator down, and we are seeing these gaps closing that we had on the S&P 500. Now we still do have two more gaps below us, and we are reaching critical Fibonacci areas as well. So it is possible that we do see a technical bounce soon, but that does not mean that there's not further downside coming. So right now we still have a gap at $330 and then another gap at $327. Now we are also finishing our fifth wave of our Elliott wave analysis, so we are expecting to see a sort of ABC correction. And right now it's looking like we're very close to filling these two gaps below us, so it's highly likely we're going to fill those gaps before resuming any amount of uptrend. Now there is another very scary thing we see on the technicals, where we see that 5 EMA has finally crossed over that 13 EMA, which is telling us that the bullish trend is now reversing into a bearish trend. That goes hand in hand with our ABC correction that we're expecting to see. In any event that we do get a technical bounce, it's possible that this 13 EMA is going to act as resistance before we resume down. Now we are still trading above the 50 EMA, which is looking like it could still offer support right around this gap fill at $330. But don't forget, when the market is crashing down like this, it's called a falling knife, and you never want to try to catch a falling knife. This market has trained people to buy the dip, and every time we've seen a dip in the market went screaming back up. So there's still a lot of retail investors that are going to be jumping in way too soon, which is going to only add fuel to the fire when they eventually capitulate. It's very possible after a run like this, where everybody's conditioned to buy the dip and get rich quick, that we're going to see a significant pullback in the market, and the market's going to try to shake out all the retail investors who are chasing this thing at the top. So remember, you want to be like smart money. Smart money doesn't buy in and FOMO in at the top. Smart money was buying in when we had the crash and accumulating positions throughout this run up. Now all that smart money is ready to dump their positions, and they want to hand you the bag as the retail investor so that they can run out and profit take, and they could lock in their gains. So don't feel like you're gonna miss out, and don't feel like you have to jump into this market too soon. Let that market tell you when the bottom's in, and we're going to see it in the price action, and we're going to see it in the technicals. We'll know when the market's bottomed because we'll see something in the chart that tells us that we've likely hit a bottom, and we'll see some sort of trend line or reversal off of this downward trend. So right now there's no doubt we're in a downward trend with the 5 EMA closing below that 13, and the price action closing well below the 20 simple moving average now. Now the volatility is still high, and we're seeing these very drastic swings in the market, and we still have another day or two to see how we're going to hold up on the 50 EMA. Now, unless you have a crystal ball, you can't just assume the market's going to bounce off that 50 EMA. And if you have a crystal ball, please let me know where the bottom is, because I'm dying to find out. So on the Fibonacci retracements, it's likely now that we're going to see the 50% retracement because we've already blasted through the 38.2. Now the 50 is right around 327, which also is the gap closure and the significant support that we're going to find around 327. So in any event that we don't see a bounce tomorrow, I wouldn't be surprised to see this A wave come down, close the gaps, before ultimately bouncing back up and then ultimately heading back down and possibly going to another Fibonacci retracement of a larger cycle. So right now it's very possible that we do see that bounce, but that is going to be a bull trap for Ricky investors, and they're going to think that that is the dip buying opportunity they've been waiting for. So in any event that we get a bounce, don't be dying to buy in at these price levels, because ultimately we're going to hit a B bounce and then resume downward to a C move. This is the ABC correction that's very typical after 5 wave Elliott waves, and we've definitely seen the 5th wave. If anything, this 3 days of selling is telling us that that was indeed the short-term top that we just saw. And yeah, while we could go back up and test those highs, it's not as likely with the VIX this high and the volatility that we're seeing that we're going to rebound and hit those new all-time highs in just a matter of days. So right now we have to respect the price action, and we have to respect the trends, and that's telling us with the 5 EMA crossing below the 13 to go into defensive mode and get ready for what's possibly a trend reversal. So now I would be expecting to see lower highs and lower lows, and we do see today's close is also a lower low. There is no doubt that it is lower than the previous swing that we had right back here on August 20th. So if we switch over to a 1 hour chart, you can see this much better, where you can definitely see that the market has been seeing lower lows and lower highs ever since we started selling off from the high. So anytime we see lower lows and lower highs, we're waiting for a trend reversal. So we've reversed from a trend of higher highs and higher lows to now a trend of lower highs and lower lows. So just like we don't want to try to call a top, we also don't want to try to call a bottom. And we've only been selling off for 3 days now. So you can also see that we're approaching the bottom of the Bollinger Band. And when we were overbought, we were well above the upper Bollinger Band. So we're really just seeing a high swing of volatility in the market, and we're swinging from highs to lows in a matter of days now. And that's what the VIX was telling us. When the VIX was getting elevated, you remember me saying we're going to start seeing those 4 to 5% swing days, and we're starting to see volatility stay increased. So it's very possible with the VIX this elevated that the market's going to continue to keep swinging very drastically in intraday trading. So if you're new to trading or you're new to investing, your best bet is to kind of stay on the sidelines and let this thing calm down until we see some sign that a bottom was put in before going long. If you're a trader, then you love volatility because you could be trading and scalping positions all day long. Because we've seen volatility stay in the market, it's more likely we're going to see those days where the price action is moving 4 to 5%. So if you're not sure how to trade volatility, your best bet is probably don't be trading right now and wait till everything calms down. So on the SP 500 SPY ETF, we're going to have a critical test of the 50 EMA as soon as tomorrow. And we're really looking for these gaps to close at 330 and 327. And if you watch this weekend's video, don't forget about the gap we have way down here that brings us all the way down to 286. So if this market's going to stay volatile and we're going to see a continuation of the selling, I wouldn't be surprised to see our ABC bounce look something like this. Now, I'm not guaranteeing this will happen, but it is a possibility we cannot forget about because gaps typically get filled in the S&P 500 ETF. So we're in full defense mode right now, and right now we're waiting and watching these levels of support that we know are there. And right now, every level of support that we've had since this sell-off has been blasted right through like it wasn't even there. So let's let the market bounce off of a level of support before ultimately deciding what this market wants to do. Right now, it's very obvious this market is trying to sell off. And we're waiting and we're watching the price action, and we do have a trend reversal from that bullish trend because that 5 crossed below. We need to get defensive and we need to leave open the possibility that we could be entering into a bearish trend. So next up, let's jump over to the Nasdaq 100, and we are looking at the QQQ ETF here, or the triple Qs, and we see the same exact thing with the triple Qs with that 5 EMA crossing below that 13 EMA. We also closed well below the 20 simple moving average. And it is very close to call, but it also looks like we closed below the 50 EMA. Again, these are all very bearish signs, and it's a sign that that bullish trend has reversed, and we're starting to see the price action in the trends reverse to a bearish trend. Now, 3 days don't set a trend, and we still need to wait and watch for that ABC correction. And we are watching a very similar thing where we're going to wait for that bounce and then ultimately see how low that C wave will take us before seeing if that uptrend is going to continue. So right now we are approaching some support levels on the QQQ ETF, and we do have our 50% Fibonacci retracement at $267. We also have this support level here at $264. So I wouldn't be surprised to see a bounce off of these levels before resuming our downtrend, but we really are waiting to see those levels hit if they're going to be support. We don't want to make any assumptions, and we don't want to just make an assumption that it has to bounce because there's a support level there. As I said before, the same support levels we've had in the past have been blasted right through. Now, if you're going to try to make a trade off of these support levels as a guess, don't forget to set your stop loss right below support so that in any event that you're wrong and we don't get a bounce, you get stopped out before we resume a downtrend into these next support levels much lower. So we do see the increased volume on selling, which is telling us that that smart money is starting to dump their positions. And when smart money sells, the market could continue to go down for many weeks. The smart money had been accumulating along this entire bull run. And if you're FOMOing in at the top, you're just chasing something that you missed, and you have to acknowledge that you missed it and you're going to catch it next time. You don't want to be throwing your money in at the top while we're tanking like this because you're just going to lose all of your money and you're going to be out of the game. You're much better off holding that cash and preparing for a buying opportunity than you are to just destroy your account because you're too impatient to wait for a bottom. So right now on the Nasdaq 100, it looks like we could be getting very close to a technical bounce, and only about 1 to 2 more down days would bring us into significant support that we could see that bounce off of. Remember though, a bounce is expected to be followed with a further move to the downside. So if you're buying in on the bounce, you're also still counting in as the FOMO crew because you're going to see this possibility that you're making some money on that bounce, only followed by further selling, and you're just going to get trapped into another position. So I wouldn't try to catch the bottom, and I wouldn't try to follow the bounce. I would wait for this C wave to tell us when the bottom's in. If you're a patient trader or a patient investor, you're going to have a lot better successful trade if you just wait a few more weeks or a couple more weeks, however long it's going to take, to ultimately see where this market is going to bottom and then see which direction the trend is going to set itself in. A rule of thumb right now would be the entire month of September is going to remain volatile, and the entire month of September is likely going to be a month of corrections where we see drastic swings and bounces, dead cat bounces, falling knives. I mean, everything the stock market has is going to get thrown at you into a month like September. With volatility this elevated, you're going to see a little bit of everything. If you're not an experienced trader, you're better off just waiting. Next up is the Dow Jones Industrial, and we're looking at the DIA ETF, and we do see the Dow Jones closed another gap today, so we're going to go ahead and delete this gap. And we do see the Dow Jones still has 2 more gaps below as well. So we still do have lower price targets on these ETFs that we're tracking. And we also see that 5 EMA is crossing below the 13 EMA on the Dow Jones as well. So overall, all 3 indices that we do technical analysis on are showing us a trend reversal from the bullish trend, and we could be heading into a bearish trend. So we're still waiting to see if these gaps are going to close, and right now it's looking higher and higher likelihood that we're going to see those lower gaps close before we find support. Now on the Dow Jones, we still do have this support level and we could see a technical bounce, but like I said, that's only if you have a crystal ball and you're trying to catch a bottom. Good luck. Next up is the VIX, which as you know is our fear indicator, and we've been tracking the VIX very closely, and we've been saying it's going to show us some warning signs of what's to come. So back in the end of August, we saw the VIX was showing a trend reversal, and we saw that the VIX was coming bullish after a bearish downtrend. So when the VIX is bullish, that tells us we're going to expect fear enter the market, and that's exactly what we've been seeing. There's been a ton of fear recently in the market, and that's been leading to these downward sell prices that we're seeing. When the VIX is this elevated, there's no reason to try to time the bottom. Wait for the price action to show a bounce, and let's ultimately see how low the correction is going to take us. If we go back to the S&P 500, when we first saw signs of a trend reversal at the top here at the end of February, nobody in their right mind would have guessed that the stock market was about to drop over 30% in just a matter of weeks. I'm not saying this is going to happen again, but this is the kind of discipline as a trader you need to have in your back pocket, because we were also saying back then to expect this ABC correction. Well, that ABC correction was a huge ABC, and while it was a B bounce, if you tried to catch this B bounce and you just thought it was going to come down a little bit and then ultimately resume its uptrend and you're buying down here, well, you got destroyed by the stock market because we continue to drop. So ultimately, when we see that pivot bottom in at the bottom of that C wave is when we want to be buyers. And right now, with the VIX as elevated as it is, the market could continue to drop much lower. So please respect the VIX and understand that when the VIX is at these levels, the market is going to remain volatile and you're going to see drastic swings and you're going to get tricked. There's a lot of people who were buying on this bounce who thought that that was the bottom, and they held their position the whole time that this thing was crashing down. So we really are waiting for a very similar structure. The ABC could look like this, the ABC could look like this, or the ABC could look like this. We don't know. So we really need to watch the price action and we need to watch those technical trends. So going back to the VIX, we see here that the VIX is extremely elevated right now and it's still showing this bullish trend. Look at the 5 EMA well above that 13 EMA, and we're seeing the price action on the VIX continue to close above the 5 EMA. That's showing a very strong bullish trend on the fear indicator. And as long as the fear indicator is this high, we're going to continue to see sell-offs and drastic price swings on these indices. So let's jump into some of the sectors that drive this market. And first up, we have the financials. And we do see the financials finally breaking out of our consolidation wedge, unfortunately, to the downside. So now we have to start watching the financials, and we have to start worrying if the financials are going to break into a bear market. So if you remember, the financials have yet to form a higher high since the crash. And we do know that a bear market has lower highs and lower lows. So as soon as we get a lower low on financials, that's going to tell us that financials are in a bear market. That is what a bear market is defined by. Price action that has lower highs and lower lows. So we already have the lower highs, and now we're getting ready to form a lower low in any event that the financials continue to sell off. So overall, you really need to be very defensive in the stock market right now, because we're getting all kinds of indications that we may have seen a temporary top in the market and we're going to see some more drastic selling. So right now we need to watch the financials and we need to see if they're going to find support before forming a lower low. In any event that we do get that lower low on the financials, look out below, because the S&P 500 has likely seen its top for the year and we're not going to see new all-time highs. Next up is the industrials, and we see a very similar sign with the 5 EMA threatening to cross below that 13 EMA. We see the price action closing below the 20 simple moving average, and we're now getting close to getting to the bottom of the Bollinger Band. So overall, we're seeing a lot of evidence of a bullish trend reversal, and we're possibly seeing the beginning of a bear trend. Now we see the price action still has a lot of support where it could bounce off the 50 EMA, but we are seeing that trend reversal, which is a very big caution flag that we need to acknowledge, and we don't know where the bottom's going to be. The bottom could be way lower, or we could have seen the bottom today. Nobody knows, so we need to wait and watch for that trend reversal. And right now we're seeing a downward trend beginning to start, and we need to respect that. Next up is healthcare, and we see more bad news with healthcare, closing well below the 50 EMA, and we see that 5 EMA crossing aggressively down to the downside. And we do see that 5 EMA even getting ready to test crossing below the 50 EMA. So overall, we've now done technical analysis on all of the sectors and all of the indices, and we're seeing a huge trend reversal on all of them. That is never going to be a good sign for the stock market. It's very likely that we've seen a short-term top, and we're going to see a month long of selling in September. And September is going to remain volatile, and it's going to remain a month of correction is what it's telling us right now, as we see price action starting to show profit taking from that smart money, and that smart money drives the market. They're the ones with all the volume and all the power. If they want to sell, the market is going to come down. When they want to buy, the market is going to start going back up. But right now we see more evidence of selling than buying. And right now I would not be a buyer in the stock market until we see evidence that we've hit a bottom. Next up, let's do some analysis on the US dollar, and we're looking at DXY here, and we do see strength returning to that dollar. So another thing we've been saying right here on this channel is when we see strength return to the dollar, watch out for that stock market correction. So with the dollar, guess what? We formed a higher high today. What does a higher high tell us? A higher high tells us that we're entering a trend reversal from a bear market in the dollar to a potential bull market in the dollar. At the same time that we formed a higher high, we see the 5 EMA crossing above that 13 EMA, which is another sign that we're seeing a trend reversal from a bearish trend to a bullish trend. So now we have a higher high on the dollar. We're going to look for a higher low, and we're going to look for that dollar to show continued signs of strength. As long as the dollar is showing strength and we're seeing that dollar go up higher to higher prices and forming those higher highs, we're going to expect the stock market to continue to correct and remain volatile. So right now the dollar is aligning with the sell-off, and the strength of the dollar is leading to the sell-off in assets. That's exactly what the dollar has been doing as it was declining, is the weak dollar was actually leading to asset prices inflating. So now that asset prices have inflated and we're seeing strength return to the dollar, we're going to see asset prices come back to normal, and we're going to continue to see that correction until we ultimately find that fair valuation. So next up is gold, and we see gold still holding up nicely at support, and we do see a test of the 50 EMA today. But right now on gold, we did have that bullish breakout, and we're still holding up here at support. So ultimately we want to see gold bounce and see if it's going to break this previous high and form a higher high, which will tell us that gold's going to go into that bull market that we've been waiting for. However, any break to the downside below this support level is going to tell us that gold is probably seeing its new high for now, and we're going to see a bear market in gold. With the dollar strengthening, I wouldn't expect to see gold going higher. So if that dollar keeps showing strength, I think we're going to see gold break down to the downside. So if you're a holder of gold right now and you see the dollar continue to strengthen, you might want to consider taking some profits on your gold. Next up is our FOMO stocks, and first up is Apple, and we still have these gaps below on Apple from before it went parabolic after the stock split news. Now I still do expect Apple to come down and close these gaps, and we're seeing Apple going down in a straight line. Remember, the stairs up and the elevator down. So Apple is absolutely a market moving stock, and the fact that it was FOMO'd into led to some of those asset prices getting into that bubble that we're now seeing the correction from. So right now there could be more downside on Apple. We have yet to test the 50 EMA, and we do see that trend reversal with the 5 EMA crossing down below that 13 EMA. So there could be more trouble in stocks like Apple, and there could be more trouble ahead for the indices because Apple is a market moving stock. When we see Apple getting beat up like this, we're not going to expect to see the stock market going higher. Our other FOMO stock, of course, is Tesla, and we see Tesla got absolutely routed today, closing down minus 21%. Now again, that really is not that surprising because Tesla got FOMO'd into and it went parabolic, and now we're seeing this blow off the top where we went up very rapidly and now we're going down very rapidly, forming this peak here. Now I would expect to see Tesla have more downside, and I wouldn't be surprised to see Tesla come down to the 50 Fibonacci retracement down to about 286. Now we could see Tesla go down in an ABC and ultimately hit 286 on the end of the C wave, or we could actually hit 286 on the bottom of the A wave before bouncing and heading even lower. But like I said, it's like catching a falling knife, and you really don't want to try to call a bottom based off of a gut instinct. Let the price action and let the technicals tell us when the bottom is in, and then be like the smart money buying at the bottom. Don't be the dumb money FOMOing in, trying to buy this dip when we really don't know how far this dip's going to drop. You're going to have a whole lot of dip if you're buying every red day if we continue to keep falling. So right now we're seeing a sell-off across the entire stock market, and we are seeing the S&P 500 getting very close to some critical support levels. So in any event that we do close these gaps and find support, we have about another 2% to the downside before we hit this $327 level. I think the S&P 500 SPY ETF is going to bounce off that level if we don't bounce before it. And I do think we are going to see these gaps close very soon. Remember when these gaps opened and I was telling you we have to pay attention to these gaps, it's because we know those gaps typically get filled. So those gaps were our barometer for our downside risk in any event that we did get this correction. So hopefully this correction didn't catch you too much by surprise, and hopefully you have some money on the sidelines getting ready to buy the dip. But right now you have to buy the dip at a support level, and we've yet to see support. When the stock market is falling down in a straight line, that is called a falling knife, and that means we don't know where support is yet. Now, if you have your crystal ball, good luck, but I don't have a crystal ball, and right now my support levels are at $330 and $327, so those are the levels I'm looking for a bounce. In any event that we get a bounce off those levels, we would expect to have a quick trade to the end of the B move, and then ultimately we have to get out again because we are expecting further downside move to the bottom of our C. So don't FOMO into any bounce. If you're anything, it's just a short-term trade before we ultimately resume this downtrend, which is a healthy correction for the stock market. Just remember where we came from, right? An ABC correction that takes us all the way down to $300 is still ultimately a very bullish trend when we're coming down from 220 and we came all the way up to 300. That's still a very healthy growth in the stock market, and anytime we see euphoria and parabolic movement, we're going to expect to see it followed by a stock market correction. So this isn't anything bad, and it's actually healthy for the stock market to go through these 10 to 15% corrections after we've seen this huge run up in the stock market. So remember too, we have our resistance trend line up here, and every time we've touched that resistance trend line, we've followed by a significant pullback. So if we go back and we follow this resistance trend line, we see significant pullbacks when we hit this area on the stock market. And it's been a very critical trend line calling the top in the market. So right now we have to acknowledge the fact that we penetrated that resistance trend line and had this false breakout, and now we're paying for it because of all of those people that were FOMOing in and chasing these stocks, driving the stock market to crazy valuations. The smart money is ringing the cash register, and they're calling in their gains and they're locking in their profits for the year, and that's what they want to do. They want to run up the stock market so that they can sell to you at higher and higher prices, so that when they profit take, they're actually locking in their gains for the entire year. So remember, this isn't the end of the world. We're going to see a bounce after this correction, but we really need to wait and watch that price action, and we need to watch those trends. So if you need help in the stock market, that's why we're doing these technical analysis updates for you. So go ahead and smash that subscribe button and follow along right here on this channel. And if these videos are helping you out, please help me out by smashing that like button on this video. So good luck out there, everybody. I'll be there with you every step of the way right here on the Stocks channel. And as always, I will see you in the next episode.